Good morning. This is Bloomberg Daybreak Europe. I'm Anna Edwards in London, and these are the stories that set your agenda. It's a mixed picture for stocks to start a week dominated by central bank decisions, including a likely cut from the Fed. China's trade surplus tops $1 trillion after exports rebound. JPMorgan chief Jamie Dimon says Europe has a real problem, warning that a weak continent poses a major economic risk to the United States. Plus, President Trump voices disappointment in Zelenskyy's handling of Ukraine peace talks. The UK Prime Minister Keir Starmer prepares to host the Ukrainian, French and German leaders in London today. Welcome to the programme, everybody. It is Monday morning. It's just gone 6 o'clock here in London. Very warm welcome to Daybreak. Let's have a quick look at what we're watching on these markets then this morning. Ahead of the open here in Europe, we are looking at a pretty mixed picture for futures. Pretty flat to negative picture for European stocks. So European stock futures down by 0.1%. FTSE futures down by 0.1%. Elsewhere, the story is a little bit more positive. US futures are pointing a little higher. S&P, NASDAQ futures both up by around 0.2%. Global stocks rebounding through the second half of November, back to those levels that we saw in October, around all-time highs. So that seems to be the overall context for these moves. And of course, we look ahead to a lot of activity from central banks this week, including, crucially, an expected cut in interest rates from the Federal Reserve. Let's have a look at some other assets and how they're responding this morning. We have a Fed decision to look ahead to. So we've got the US 10-year yield in here at 4.14%. A lot of conversation about how the Fed cuts in interest rates to date during this cutting cycle, how they haven't necessarily fed through into the real economy in a very typical fashion. There are still concerns around inflation, and that perhaps is keeping some of those longer end yields a little bit elevated. Also concerns around supply, or is it just confidence in the US growth story? All of that in the mix there. Euro dollar at 116.68, so up by 0.2% right now. I'll come to that in just, in fact, I'll mention that right now. So up by 0.2%. ECB's Schnabel saying she's comfortable with bets that the next move will be a hike, which is interesting to see that move then in euro dollar coming through this morning. A lot of the other voices we've heard recently from the ECB have been talking about keeping options open and not committing to a forward rate path. So interesting to see her take there. Also interesting in the context of the Chinese export data, which has certainly suggested that cheaper Chinese exports have been coming more frequently into Europe of late. So we'll see, keep an eye on that. Japan in focus, heading towards that BOJ in the next couple of weeks. And we've had wage and GDP data out of there, and copper at a new all-time high as the electrification and energy transition stories continue, and supply issues are continuing to be a feature of these markets. Let's get an update on Asian markets and how they're faring. Winnie Su is with us from Hong Kong.
Morning, and now we are seeing that Asian stocks just up slightly here, up 0.3%. And still, like you mentioned, it's mainly driven by the expectation for the Federal Reserve to cut rates this month. Now, that's helping technology shares to lead gains in Asia, with Kospi and also Taiwan's TAIEX leading gains. Now, Australian stocks slipped a little. We are waiting for that decision from the RBA due tomorrow. Right now, the expectation is for a hold. Now, zooming into the Chinese market, as you mentioned, all eyes were on the trade data, and let's see how markets are moving. And interestingly, we are seeing a divergence when it comes to the onshore market and the offshore market. So onshore really leading gains here. We've got, yes, that export numbers coming stronger than expected, and like you mentioned, it really goes to highlight how the resilience of Chinese exporters still is very strong, and also with that trade surplus topping that $1 trillion so far this year is also a new record. And beyond that, very interestingly, we also hear from Chinese authorities that they are considering expanding the leverage limit for brokerages, and that is really helping investors to move their money away back into their onshore domestic market from the offshore market. Now, flip the board and we take a look at what's going on between China and Japan, because we are seeing the tensions still intensifying, and that is really affecting different sectors here. You've got China's fighter jets actually targeting some of these Japanese military aircrafts, and hence defense stocks here in Japan rising, with the MHI actually leading gains of the broader other topics index in Japan. And beyond that, also seeing some moves when it comes to the airlines stocks, because some of these top Chinese airlines are actually waiving cancellation fees to and from Japan in terms of these trips until end of March. So really goes to show how these geopolitical tensions between the two countries in Asia still pretty much in focus. Back to you, Anna.
Winnie, thank you very much. Winnie Su in Hong Kong. Let's pivot the conversation to the big monetary policy decision that hangs over markets today, and that is, of course, the Fed. Fed Chair Jerome Powell is expected to push through another quarter-point interest rate cut this week, despite growing unease among some policymakers that inflation remains too high. Let's bring in Bloomberg's Valerie Teitel, who is with us now. Valerie, good morning. It's Monday. We're looking ahead to the Fed, middle of this week. I mean, what is your area of focus as we head into this meeting? Is it going to be around whether there are dissenting voices? Is it going to be around any clues we get about future leadership? What's the focus?
Look, I think the focus really is going to be on how fractured is this Fed and how is it going to show up not only in the number of dissents that we get, but maybe a muddled message in their economic forecast. Remember, we get the dot plot and their updated forecast when it comes to growth and inflation alongside the rate decision on Wednesday. And this does follow an outburst of hawkish Fed regional presidents calling for the fact that they are uneased by the fact that they are cutting rates still with inflation above target. Now, the market is very much assuming the Fed is going to go ahead and cut interest rates this week. We're pricing it around a 90% probability, and that comes after New York Fed President John Williams voiced his support for a cut. He's seen more of a centrist and someone who holds the view of Powell as well. So we're not necessarily concerned that they won't go ahead and cut rates. It's the fact that we could have up to 5 dissents, Anna, and something like that does not happen very often within the Federal Reserve. If we look at the times where we've just seen 3 or more dissents in a decision, we've not seen that happen more than 9 times in the last 35 years. So very rare to see the Fed this fractured. But again, it comes in the backdrop of having a lack of clarity when it comes to data. We're still waiting for this backlog to clear amidst the government shutdown and the fact that we have political pressure on the Fed to reduce interest rates. These two factors are really seeming to have a divisive impact on the Federal Reserve.
Yeah, it really will be interesting to see how the markets respond with expectations around 2026 and cuts there, given the lack of data and given that we are going to see personnel changes at the Fed. Let's stick with monetary policy and think about where it goes from a European perspective, because we've had some really interesting news flow here. The French President Emmanuel Macron has been weighing in on what he thinks the ECB should be doing. And we've also had these lines out from Isabel Schnabel. I mean, hawks say hawkish things, but it has pushed up the euro.
Yeah, we have seen a little bit of strength in the euro this morning. It's higher versus the dollar by around 0.2% on the back of comments from Schnabel. Note she is a more hawkish-leaning member of the board, as you just alluded to there, that she's comfortable with the market pricing that the next move is a hike. Now, she does note that interest rates are unlikely to change anytime soon, so giving a nod to the fact that the market isn't necessarily pricing the ECB changing its policy until around 2027. But this does come amidst a backdrop of maybe growing political pressure on the ECB. We had a rare comment from a European leader, that was Macron, talking about perhaps some changes he wants to see to their sole mandate. The ECB just has one mandate, it's inflation. But he was questioning over the weekend in an interview with Los Echos whether they should add growth or employment to that kind of the mandate. And this comes with the backdrop of Europe having quite a stagnating economy in the last few years. Germany, the growth engine, has really been hampered by many factors when it comes to trying to boost growth within Europe. And we could see maybe some more political pressure coming from these leaders of the ECB wanting to target not just inflation, but perhaps a growth mandate as well.
Yeah, and I think we get some German data out a little bit later out this morning, don't we? Valerie, thank you very much. Bloomberg's Valerie Teitel setting us up for the week ahead when it comes to monetary policy. Let's focus on what's been happening with Ukraine, because President Trump has expressed his dismay in Ukraine's leader over the handling of a U.S. proposal to end the war in Russia. Here's what President Trump told reporters in the United States on Sunday.
We've been speaking to President Putin, and we've been speaking to Ukrainian leaders, including President Zelensky. And I have to say that I'm a little bit disappointed that President Zelensky hasn't yet read the proposal. That was as of a few hours ago.
Bloomberg's Oliver Crook joins us now from Brussels with the latest here. Ollie, this development comes as the UK Prime Minister Keir Starmer is preparing to host multiple European leaders. Macron and Merz will all be in London for these peace talks. What's the status of things?
Yeah, so if we look back the last couple of days before we cast it forward, on Friday we had the White House and the Ukrainians basically saying that they had agreed to a framework for security arrangements. Again, sort of a broad and sweeping statement, I think, in order to give continued momentum to these conversations. And on Friday, you also had Friedrich Merz, who came here to Brussels to try to lobby the Belgians to try to get on board with the frozen assets. That was Friday. On Saturday, we understand Zelensky spoke with Witkoff and Kushner on the phone. And then we heard from Trump yesterday basically saying that he felt that Zelensky had not fully appraised the proposal yet. He was a little bit disappointed by that fact. We did hear that Zelensky was going to get a full briefing from the United States talks on Monday, when we're expecting him to meet with Macron, Starmer, and Merz a little bit later today in London. We should say that in terms of what the expectations are from that meeting with the Europeans, so far, whenever you've had these meetings, whenever you had coalition of the willing meetings, nothing really transformational has broken through. We are still also waiting to hear potentially from the Russians. They've been very much more guarded about this process than, say, the United States has, in terms of trying to promote some optimism about it. And then we should also say, and I think, Anna, this is the most important thing here in Europe, we basically are a week and a half away from that EU leaders meeting at the end of next week here in Brussels, which is really seen by many as a sort of last opportunity for the Europeans to make a decision on whether or not they're going to put pressure and move forward on those Russian assets. We should say that our reporting over the last couple of days suggests that the United States has actually put a lot of pressure on European leaders to not do so, because the U.S. wants to use those frozen assets within their own sort of framework and rubric.
Yes, absolutely. We got some news around that pressure, didn't we, on Friday? Now, President Trump's approach to Russia-Ukraine is part of a much broader U.S. foreign policy shift, Ollie, which the White House really articulated on Friday and has caused a lot of ripples, more than ripples, through Europe. So this national security policy, I mean, for some, this is just a formalisation of things we already knew when J.D. Vance was over in Munich earlier this year, for example. For others, this is evidence of what they feared.
Yeah, and if you have any doubt about whether or not it's endorsed by the president, his signature appears on the second page in fairly large font there. But basically, yeah, it is articulating basically some of these ideas that we heard from the president, that we've been hearing from the administration. But as you say, Anna, it sort of formalizes it into sort of a document that people can refer to. And I'll just quote parts of it. The very beginning of it says that the days of the United States propping up the entire world order like Atlas is over. That is not going to come as a massive shock to anybody. Basically, the United States wanting to withdraw from certain regions. But the reading on Europe, I think, is going to create a great stir here in Brussels. Basically, that they're advocating promoting European greatness, with, for them, includes ending the perception and preventing the reality of NATO as a perpetually expanding alliance is one of the points in there. He believes, and the U.S. Trump administration believes, that the European continent faces potential civilizational erasure, and that he's basically advocating, and the U.S. is advocating, cultivating resistance to Europe's current trajectory within those nations. So it's a sort of foreign policy posture from the United States that is advocating sort of interfering quite explicitly within European politics domestically, and also suggesting that basically in the long term, demographically within Europe, that many of the nations within NATO could potentially be so-called non-European anymore, therefore potentially not really affiliated with the original values that sort of launched NATO. Add to that the reporting that we had last week from Reuters, saying that basically the United States wants to give all of the sort of conventional responsibility for NATO to the Europeans by the end of next year. It creates a very sort of short timeline. But again, this serves the U.S. administration because it promotes their own sort of domestic agenda in other European countries. But again, it promotes sort of nationalism and fragmentation within Europe, which sort of guarantees a more docile Europe in terms of negotiations on a number of other issues, including trade.
Yeah, really interesting the way that that document set out support for populist, nationalist, or national structures rather than supranational ones. Ollie, thank you very much. Oliver Crook joining us there from Brussels with all that you need to know about Ukraine and US foreign policy. Coming up on the programme, Abu Dhabi is rewriting the sovereign wealth investing playbook. We'll have more on that story next. This is Bloomberg.
We are having too much debt. Now, this is not just the United States. You're seeing this in England, you're seeing this in France, you're seeing this in China, you're seeing that dynamic. So that they can't increase the debt the way they did before. And then related to that is the politics. When you have these large wealth gap differences, who has the money? And when there's the accumulation of a lot of wealth that then isn't taxed, there's a tendency to want to tax that wealth. And that creates bubbles. In other words, when wealth is very different from money, in order to spend money, you have to sell wealth and get money. And when there's a lot of wealth that needs to be sold. So quite often interest rates play that role, but you could see wealth taxes play that same role, meaning the need to sell that. And that creates a bubble. So we have a debt bubble going on. We have that other kind of a bubble going on in the economy and related to politics. And then, of course, geopolitics. Capital flows and trade flows are different because we have a world in conflict. And in that world in conflict, no country could be secure. So that's why the United States wants to build self-sufficiency in these areas. Or China, which is that model where China would export to the United States and earn money and then invest in bonds, is no longer a viable path because the Chinese worry that they won't get paid on their bonds like the Russians don't get paid on the bonds. So that dynamic is what is behind now what's happening, and it's becoming more precarious as we go forward. Like if we go into the 2026 elections, it's likely that the Democrats will take the House, significant possibility. If that happens, the political conflict will continue to be more difficult, and so on. And that's creating this risky environment. Particularly also, debts are maturing. So you have to roll over your debt at a higher interest rates. This confluence of factors is making the environment more risky as we're going ahead.
That was the Bridgewater Associates founder Ray Dalio speaking with Bloomberg a couple of hours ago at the Abu Dhabi Finance Week. And staying with the region, Bloomberg's Big Take story this morning explores how deep pools of wealth are giving Abu Dhabi unprecedented sway over global finance, energy and AI. For more, we're joined now by Bloomberg's Alex Dula, who's been tracking this story for us. Alex, good morning. So what's driving this rapid expansion then of Abu Dhabi's global financial influence?
Hi, Anna. Thanks for having me on. Yeah, so it's Abu Dhabi Finance Week this week, and it's a really important week for Abu Dhabi in general. So we wrote this story and we kind of tracked the $2 trillion of sovereign assets that Abu Dhabi is sitting on from the sovereign wealth funds, and there's three main ones. There's ADIA, Mubadala and ADQ. And we sort of tracked the investments that they're making over time, their priorities, and the key people that are sitting behind each entity.
And so where has Abu Dhabi been putting the money? With increasing amounts of money to put to work, where's that been going, Alex?
Yeah, so we've tracked it over time, and AI seems to be the sort of big topic that Abu Dhabi is going all in on. And if you look at a lot of the sovereign wealth funds, yes, there are three main ones, but there's also sector-specific entities. So you have MGX that looks at AI investments and AI infrastructure. You also have XRG that's looking at energy, specifically internationally. So a lot of these entities are kind of geared towards specific sectors, and then you have the three main ones that are kind of sector agnostic.
OK, Alex, thank you very much. Thanks for bringing us up to date. Alex Dula in Abu Dhabi. Well-timed report, given all of the gathering that we're seeing in Abu Dhabi right now for Finance Week. Now, coming up on the programme, we'll be discussing what's driving up demand for metals, including copper. A new high on copper touched just this morning. More on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. The time in London, 6:23. Through the Asia session, we've seen copper trading at a new all-time high, extending a rally driven by concerns about the impact of US import tariffs next year, also driven by some fundamental demand, perhaps. Let's get into a conversation about this. The metal is critical for electrification, of course, and the energy transition. Kwasi Ampofo joins us, BNEF's head of metals research, that is Bloomberg New Energy Finance, and he's with us this morning. Kwasi, nice to see you. So thanks for joining us this Monday morning. So BNEF has been looking at the metals market, and you just published your latest outlook on how shifts within the energy sector are going to be shaping the metals market, and that's a well-established link, of course. What did you discover?
I think there are three main things that we discovered. Just like you mentioned, copper trading at an all-time high, and for us what we saw is that there's obviously a deficit as a result of the growth in demand we're seeing in the market from transition, from data centers. But then also at the same time, unfortunately, supply is constrained. The second thing that we also noticed is the fact that if you take commodities like rare earth, for policymakers, it's increasingly becoming the most important one for them. Over the last 5 years, we've tracked incentives that policymakers have been putting in place to address the supply gap. And then we see that rare earth obviously becomes the most important. We have companies like Anglo-American Glencore starting to invest in mining again, as opposed to returning money to shareholders. And then the final thing is that countries are working hard in terms of investment and fiscal policies to diversify from China.
Yes, absolutely. So a lot in the report. Let's focus in on the copper story then. You talked about that copper deficit. We've got sort of structural issues around concern about tariffs in the United States, but the underlying demand story also interesting. So Kwasi, talk me through what's driving that copper deficit.
I think if you look at the electric vehicle compared to the traditional internal combustion engine, you're looking at, for copper consumption alone, you're looking at multiple times the amount of copper that historically we're using in the normal cars. And if you take even the amount of grid connection we need to connect all the solar panels that will be built over the next 20 years, we need quite a lot of that. And if you see demand now, currently we're sitting close to about 30 million. That could rise to about 50 million. And that's a 20 million gap. To be able to get the mines, we need about close to 30 to 40 mines being open in the next 25 years. And we don't see that happening. In the near term, like you mentioned, the inventory is really hurting the market and driving prices up.
Okay, yes. So my next question was going to be whether companies are responding to this deficit and trying to fix it, trying to provide more to the market. I mean, that sounds like a tough thing to be able to close that deficit gap. So what are the chances that they will be successful, these businesses?
I would say they're doing quite a lot. I mean, we've seen the recent deal Anglo-American with Tech. We saw BHP try to also acquire Anglo-American. We've seen quite a lot of M&A activities. And for us at BNEF, we tracked all the M&As that has happened the last 5 years, and you can see that copper obviously stands out quite high, followed by lithium and the rest. But I think for now, companies are trying. But then on average, it takes about 10 years to build a new mine. So still a lot to be seen.
Yeah, OK, so there's a substantial lead time between the market giving these signals of deficit and the extra product coming out of the ground. So what about rare earths? You mentioned that as part of the conversation earlier, Kwasi. I mean, why have rare earth minerals become as important as they are? A lot of this has to do with technology, electric vehicles, energy transition, all the rest.
So there are two sides to that story. There's obviously the demand side. It's very critical to industries such as defense and the energy transition you mentioned. But then also, it's also one of the few metals where China has complete, total control, both at the upstream and the downstream. So if I was a policymaker in Brussels or DC, and one of my most strategic minerals is totally under control at the upstream and the downstream by one country, I'll be worried. And as a result of that, that's why we've seen a lot of policy focus going to address that gap. Yeah,
absolutely. A lot of focus on the Chinese stance there with its rare earths. Thank you very much, Kwasi, for joining us. Really good to speak to you. Kwasi Ampofo, BNEF's head of metals research. Coming up on the programme, we'll be looking ahead to Wednesday when the Fed is expected to cut interest rates, of course. Our guest this morning, Pilar Gomez-Bravo, co-CIO for fixed income at MSF Investment Management. We'll get her perspective on cuts this week and next year. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Anna Edwards, live in London, and these are the stories that set your agenda. It's a mixed picture for stocks to start a week dominated by central bank decisions, including a likely cut from the Fed. China's trade surplus tops $1 trillion after exports rebound. JPMorgan chief Jamie Dimon says Europe has a real problem, warning that a weak continent poses a major economic risk to the United States. Plus, President Trump voices disappointment in Zelenskyy's handling of Ukraine peace talks. The UK Prime Minister Keir Starmer prepares to host the Ukrainian, French and German leaders in London today. Welcome back to the programme. 6:30 here in London. So an hour and a half before we see equity trading here in Europe. The futures picture a little bit sluggish here in Europe. The picture on Friday was pretty mixed for Europe. The US made some modest gains. Europe doesn't seem to be wanting to catch up with those particularly today. S&P futures in their turn are up by 0.2%. So by the time we get to the United States, maybe something a little bit more positive in terms of the mood and the sentiment as we head ever closer to the end of the year. Not quite there yet. Let's have a look at some other assets. We've had some really interesting news flow surrounding the euro this morning, and so that's certainly going to be in focus. We've got US 10-year yields first up, and that's in focus because of the Fed decision, of course, and whether we are seeing the Treasury market respond in an atypical fashion, really, to the Fed's interest rate cutting cycle. The euro at 116.62, spiking a little this morning, up 0.2% on comments from Isabel Schnabel. She's laying her hawkish cards on the table, I suppose, in a way that many ECB leaders have not been wanting to do. Copper, also of interest. We just discussed that with Bloomberg New Energy Finance. The copper price up at new all-time highs this morning. Now, the relationship between the US and Europe very much in focus these days, so let's focus in on that for a moment. JPMorgan CEO Jamie Dimon says Europe is facing a real problem as slow bureaucracy drives out business and innovation. Dimon also told us that the continent's weakness poses a major risk to the United States.
We have moving tectonic plates. You've heard us spoken about. It's AI. You know, the enemy's in the satellite up above and in your computer systems right now. You know, and the world changed. The other tectonic plate is the rise of China, huge global deficits, social network programs that probably can't be maintained over a long period of time. So Europe has a problem. I think they accomplished an unbelievable thing when the Euro got together, the EC, and they said, you know, let's live in peace and not war. You know, they had World War I and World War II, but they had the Franco-Prussian Wars, the Napoleonic Wars, the 100 Years' War, the War of the Roses. You know, and so living in peace is a good thing, but it got bogged down. They never finished the common market. It takes 27 nations, you know, to make a decision. They let their military drop dramatically. It's very bureaucratic, which is why part of the reason that, you know, they lost Britain to the EU, which I think makes it bad for both of them, by the way. And so you got to be honest about this. So, and those tectonic plates may move over 20 years. But if we ever write a book about how the West was lost, it will be because of the following. It will be because of we didn't get our act together here, and we go through all the policies here, that we didn't have the strongest military in the world, and that we allowed Europe to fall apart. And so I have a slightly different point of view about Europe. They have some wonderful things, but they've gone from 90% of the GDP of America to 65%. That's not because America did anything bad to them. It's their own bureaucracy, their own costs, they do some wonderful things on their safety nets. But they've driven business out, they've driven investment out, they've driven innovation out. It's kind of coming back. I think the leadership, Merz, Macron, Maloney, Starmer, I think they know. I just think politics is really, really hard. Therefore, the fragmentation of Europe, if they fragment, that's exactly what some of our adversaries want. They want to go back to a world like that. And then you kind of have a world that was like it was before World War I, everybody out for themselves. Everyone's got different national security interests, whether it's food or energy or water. And, you know, China's a huge country who wants to do bilateral negotiations with every country. If they fragment, you know, then you can say that, you know, that America first will not be around anymore. It will hurt us more than anybody else because they are a major ally in every single way, including common values, which are really important. So therefore, I think we should be using our American capability, strength, coercion, democracy, trade, investment to urge them to do what's in their own self-interest, which is military and economic, and the economic is equally important.
JPMorgan CEO Jamie Dimon there with views that seem to contrast a little with those from the Trump administration around favouring a slightly weaker Europe, perhaps. Now let's turn to some of our other stories that are making news this morning. Switzerland's population could be capped at 10 million people if a plan by the right-wing People's Party is successful in a vote expected next June. The party has long campaigned against immigration and warned about the impacts of fast population growth. A poll by a local newspaper group estimates 48% of the country could vote in favour of the plan. Homes in the UK worth more than £2 million could lose 5% in value next year. That's according to forecasts from the UK broker Hamptons. The drop could occur as a result of the market adjusting to a so-called mansion tax announcement in the November budget. The price correction could see the largest yearly drop in value since 2009. And an industry survey finds that salaries are picking up in the UK after months of near stagnation. The Recruitment and Employment Confederation and KPMG say starting pay for permanent staff has risen at the fastest pace in 5 months in the month of November. That's as firms step up efforts to attract talent in areas facing skill shortages. And the French President Emmanuel Macron has warned that the European Union may be forced to take what he called strong measures against China if Beijing fails to address the widening trade imbalance. In a newspaper interview, Macron said the EU could be obliged to decouple and mentioned tariffs as a possibility. His remarks follow a 3-day state visit to China where he pressed Beijing for more investment. Fed Chair Jerome Powell is expected to push through another quarter-point interest rate cut on Wednesday, despite growing unease among fellow policymakers that inflation remains too high. Let's start our conversation with our guest there this morning. Pilar Gomez-Bravo joins us, co-CIO of Fixed Income at MFA Investment Management, with us on set bright and early this Monday morning. Pilar, really nice to speak to you. So let's start with the Fed then, the big agenda item in terms of monetary policy and, well, everything really for markets this week. So we are expecting a cut. Is the focus going to be on the extent to which the guidance is hawkish? What's the focus going to be for you?
Yes, exactly. I think that, good morning, by the way, I think the market is already pricing in pretty much a Fed cut, so that's kind of like a done deal by the markets. So a lot of it is going to be on the tone. I think in general the expectation is for a hawkish cut, basically, and therefore we could see a bit of movement, especially in the longer end of the curve in the U.S., to reflect a little bit of a pause maybe at some point, and also the disagreement that exists now at the board, and maybe that's going to create a little bit more of that focus is how much are the dissents, who's dissenting, and by how much.
Yes, I mean, how should the market interpret what we hear from the Fed this week, given we know the leadership is going to change, there's so much division, a lot of division about what 2026 will look like. I think there's a survey, a Bloomberg survey suggests 2 cuts next year. But, of course, we're going to be under new leadership. So how should the market think about those 2 things, the fact a new leader is coming and the messaging we get from the Fed?
Yeah, I mean, I think that the biggest issue for the market is around the questioning of the Fed independence. So we know that the next person is going to be somebody that Trump likes, and therefore is likely to continue to cut rates. But I think the biggest focus is going to be on the 10-year U.S. Treasury and the long end in the U.S., because that is really kind of what's affecting most of the mortgage markets, most of the lending. So you could see a steeper curve, but I think that dissent is going to be real, and there's going to be a lot of noise around sort of this new appointment. But the reality is that we're going to still be driven by the data. The data is foggy, given the shutdown, but we'll have more perspectives in the first quarter as to how consumption is doing, what investments are doing, and therefore that will definitely point towards, whether or not the Fed can cut further than the 50 basis points that you mentioned.
What is it that is keeping long-end rates elevated, or at least they're not responding in the way that you might expect to interest rate cuts? I know the front end responds more. But is it concerns about inflation? Is it concern about debt supply at the long end? Or is it a confidence in the US economy that, it's going to keep growing and the AI boom will deliver? What do you think explains those more elevated than expected rates at the long end?
Yes, I mean, I think that there's a confluence of things, as you say. The first one is obviously a mix of growth and inflation expectations. And inflation expectations here is the big question mark, especially around the lagged impacts of tariffs in general. And growth. But there's also a concern around the term premium that should be expected because again, of this uncertainty around policy in the U.S. There is still uncertainty around the developments on AI, especially AI capex and the borrowing that requires. And so, therefore, I think that there's going to still be a little bit of pressure. I don't think actually so much pressure comes from supply itself. I think supply surprisingly always gets well absorbed overall by the markets, but there are concerns around what risk premia should investors demand for higher inflation expectations, uncertainty, and also the regards to the Fed independence could again imply higher inflation down the road.
You talked in your notes ahead of our conversation about increasing credit risk, but that's going to be contained. Is that helped? The containment of that, is that helped by lower interest rates?
Yes, I think the big thing that we should all focus on is in credit spreads. I mean, I think ultimately recessions come through credit crunches. And I think the big surprise overall is that despite all these fluctuations in rates and ups and downs in Bitcoin and equity markets, that credit spreads have remained rock solid. And I think a lot of that is, again, demand at the front end of the credit curve, where there's still a lot of money going into sort of the front end of credit markets. So we do start seeing some weakness in credit spreads. I think that should be a big alarm bell for everybody.
Okay, but we're not seeing that right now, are we? Which is maybe quite interesting in itself. So in terms of where you like it, the areas that you focus on in the credit markets, you like structured credit, high yield bonds, and emerging markets, and that's one I hear quite a lot about these days.
So actually, emerging markets is exciting, especially on the local rate side. So we find ourselves looking for more opportunities in local emerging markets, rates markets, some credit markets in also, so hard currency EM markets, in particular sovereigns, liquid, not too far down or up in quality, but more in the crossover space. Structured credit has the advantage of being very short duration with still a decent spread. But I think we rely a lot on our strength of our research platform to really do the underwriting in all these areas. These are higher beta parts of the credit markets, and therefore you do need to pick the winners versus the losers because there's still going to be volatility, and we think that spreads will react to volatility.
Okay. Can I ask you about the policy backdrop in Europe as well?
Yes.
We just heard from Isabel Schnabel this morning saying that she's rather comfortable on bets that the next move will be a hike. I mean, many of the voices at the ECB much more cautious on giving any commitment to the direction of policy, but she does seem to be suggesting perhaps that we've reached a floor. She doesn't say that any hike is coming anytime soon, but she's quite comfortable with the idea that it is a hike. I mean, she's always kind of hawkish. So does this come as much of a surprise? It's pushed the euro up a little. Does it change our thinking at all?
It doesn't, because obviously who she is, right? She's a very well-known hawk. I do think, though, however, that the markets could start pricing in a hike at the end of next year, unless obviously this whole tariff uncertainty upends European growth. But otherwise, if the fiscal does come in from Germany, if there's stability and inflation is more or less at target, then we could see the markets pricing in. But I think it's too early to say that. I think the ECB is going to hedge their bets, and they're still going to sort of go both ways, depending on kind of what the data shows in the next quarter.
Yeah, the end of next year seems like a long time. Pilar, thank you very much. Thanks for joining us. Pilar Gomez-Bravo, co-CIO of Fixed Income at MFS Investment Management. Coming up on the programme, a shift from Yardeni. We hear why they are now recommending going underweight on Mag 7 tech stocks. This is Bloomberg. Welcome back. This is Bloomberg Daybreak Europe. Now, Yardeni Research is recommending a pivot to going underweight in Mag 7 tech stocks. Speaking with Bloomberg, Wall Street research veteran Ed Yardeni explains the change in his strategy.
I've been recommending overweighting information technology communication service since 2010. The problem is it's worked all too well. The two sectors now account for a humongous 45% of the market cap of the S&P 500. Of course, their earnings share has also increased, but nowhere near as far. And the same thing can be said about looking at the U.S. versus the global economy. When you look at the U.S. MSCI relative to the world MSCI index, what you see is the U.S. now accounts for 65% of the market cap of the world stock market. So it's hard to recommend overweighting something that's already quite overweight. I mean, if you just told people just to maintain the current weight of the index, that would still be an overweight position relative to what most people would think would be a diversified portfolio.
And what's fundamentally changed? Because when we talk about, overstretched valuations, they've been that way for a very long time now. And when you take a look at the AI cycle, people still point to how it is still at the nascent stage.
Well, I would say with regards to the Magnificent Seven, what's I think has changed is they're competing more aggressively against each other, and they've got more competition coming out of nowhere and somewhere on a regular basis here. We recently saw that Google introduced Gemini 3, which suddenly made everybody kind of reconsider just how strong the position is of OpenAI and OpenAI's relationship to lots of other AI-related companies. And then just at the same time, DeepSeek came back. Remember, DeepSeek, when it introduced its model back in January of this year, kind of shocked everybody because they were able to put together a pretty good AI model that worked as well as some of the other ones in the United States, but apparently it was trained on chips that cost a lot less. And now it looks like they're doing it again, and there's some talk that the latest version of the DeepSeek model is just as good as Gemini 3. So there's a lot of competition. The profit margins have been awfully high from the Magnificent Seven. That usually invites a lot of competition, and that's exactly what's happening.
Yardeni Research President, of course, talking about his shifting expectations for tech stocks and the Magnificent Seven in particular. Now, sticking with US corporate news, President Trump has raised potential antitrust concerns for Netflix's planned acquisition of Warner Brothers. The $72 billion deal would combine the world's top streaming player with the number 4 service, HBO Max, which has raised red flags from regulators. Trump confirmed that he met recently with the Netflix co-CEO.
And he's done one of the greatest jobs in the history of movies and other things. He's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about that. It could be a problem.
From that corporate news to some corporate news here in Europe. The world's largest ice cream maker begins trading today in a rare triple listing in Amsterdam, London and New York. Charlie Wells is here to talk us through the demerger of the Magnum ice cream company from consumer giant Unilever. Good morning to you, Charlie. What a way to start a Monday talking about ice cream. What are investors looking for on this trading debut?
Well, Anna, this is a big day for anyone who cares about dessert, because this is, again, one of the largest makers, the largest maker of ice cream across the board. Some of the most famous brands across the globe here. And the issue here is that management, I'm going to use a lot of puns in this hit, by the way, is trying to scoop out this company, send it out on its own to try to find more efficiencies, to try to deal with some of the challenges of this ice cream unit when it sat at Unilever. If you take a look at one of the biggest, it's this issue of seasonality. We all know this intuitively. You don't necessarily want to go down to the corner shop in the middle of December and buy a Cornetto, but if you look at this seasonality issue, you can see that play out where in those colder months, in those colder quarters, there's less growth there. And in those warmer months, over 50% of the revenue for Unilever's ice cream companies comes in those warmer months. So trying to deal with some of these issues, there are other challenges that Magnum Ice Cream Company is going to have to deal with as it heads out. They're going to try to grow margin, try to grow volume. They're going to have to deal with a complicated supply chain. And there is also this secular trend of GLP-1 drugs, of these weight loss drugs, which make people less inclined to eat ice cream, to eat more. Actually, management at Magnum has talked about how a 12% penetration, each 12% penetration of GLP-1s leads to a 50 basis point reduction in ice cream volume. So dealing with some of these challenges on their own as their shares start to debut today.
Okay, yeah, that's a really interesting stat there. Yeah, really interesting season, time of year to list an ice cream company, isn't it? But where does this leave Unilever, the company that is spinning out this business, because it is decreasingly a food business?
That's exactly right, Anna. So this is about more than just ice cream. This is about Unilever. And if you take a look at the performance of Unilever over the past year, you can see it trailing the FTSE. So a lot of challenges here on the back of inflation, on the back of some surprise management changes at the company. And now this is a challenge that Unilever has been facing. If you look at the composition of Unilever, as you mentioned, less of a food company over time, that ice ice cream unit was their smallest unit. So this should give Unilever some more bandwidth to deal with some of their higher margin businesses, some of the businesses with supply chains that are a little bit less complicated than ice cream. Ice cream, as you know, you've got to keep it frozen if you ship it across the board. That's not necessarily the case with home goods, with some of these consumer goods that they also sell a little bit simpler. This is not just about Unilever. This is also about London's attractiveness for IPOs. If we look at some of the IPO volume over time, you see it decreasing. This is a rare triple listing. Primary listing lost to Amsterdam. So London, the secondary, New York as well. The government here has been trying to make this a more attractive destination. That is not necessarily something that we want to digest in the most positive of ways. I'm going to use another pun here. We might sweeten a little bit of this deal if the price comes to market when these shares start to debut higher than expected.
Charlie, thank you very much. Excellent effort on the puns. Charlie Wells with the latest on that listing for Magnum Ice Creams. And from Magnum Ice Creams to things you might do with magnums of champagne. McLaren driver Lando Norris has clinched his first Formula One title at the season-ending Abu Dhabi Grand Prix. Norris finished third in the race on Sunday behind his McLaren teammate Oscar Piastri in second, and Red Bull driver Max Verstappen, who finished first. But the British driver's overall points haul was enough to edge out Verstappen for the championship. Plenty more coming up here on Bloomberg. We'll get back to the markets shortly. This is Bloomberg.
I wrote an essay March 12th, 2024, and it talked about the 3 I's: immigration, interest rates, and inflation. Mass unfettered immigration, depressed wages, cause housing prices to go up. President has closed the border. That is fixed. Interest rates have come down. The bond market just had the best year since 2020. And now we are working on inflation, and I expect inflation to roll down strongly next year.
That was the Treasury Secretary of course, Scott Bessent, speaking to CBS's Face the Nation. Really interesting. He was going through some of the achievements that he sees under the U.S. administration. He was talking about bringing interest rates down, which, if you look at the white line here, this is the Fed upper target rate. That is absolutely what the Fed has been doing, bringing interest rates down. But what has that done to the rates in the market that might have an influence on car loans and mortgages and the like? Well, that's the blue, because that's the 10-year yield, which is what so many assets globally are priced off, of course. And the 10-year yield has not really followed the market downwards, so it hasn't followed what the Fed has been doing. Now, of course, the Fed has more influence on the short end of the curve, you might say, but this is quite unusual, and this is going to be one of the parts of the conversation that continues into 2026, no doubt. Let's have a look at what's going on in China, because thinking about global inflation, this also takes us to China. China's trade balance absolutely soaring, by some measures over $1 trillion now, and this is really interesting because they are actually exporting less to the United States now, but more to Europe and to Latin America. And with that in mind, we're thinking about where the inflation story goes, in particular in Europe. And so that's going to be part of our conversation in the next hour of programming, no doubt, with Isabel Schnabel saying she's happy for interest rates to go higher. Well, will that be necessary if all these Chinese goods are coming to Europe? The opening trade is up next. We'll focus in on that story around the Eurozone, around interest rates. Also, of course, not losing sight of the Fed, which happens middle of this week. This is Bloomberg.